What's the tariff fallout? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, and Dave Floyd, founder of Aspen Trading. Gentlemen, it's great to have you on, and this is a special edition of Talking Markets today because as we come on air live, President Trump is also scheduled to be speaking live from the Rose Garden, unveiling what is expected to be a raft of tariffs on countries around the world. We are, with that in mind, going to be a little fast and loose today. And Peter, we're going to let you go, have a listen to what's going on, and then we're going to bring you back and get your thoughts once we get the headlines. We're going to say goodbye to Peter for the moment, and we are going to be having a chat with Dave while those headlines come out, because we thought it would be useful to hear what kind of levels you're looking at and what's going to be key to watch over the next coming days, because there's been so much volatility, really so much uncertainty around this, Dave. And before we do that, just for folks who are not familiar, because it's your first time on Talking Markets, just tell us a little bit about what you do in your approach so we can sort of have that in mind as we talk technicals here.
Sure. Yeah. First of all, thank you very much for having me on, Maggie. Clearly, I'm probably going to be one of the more unconventional guests, at least in terms of how I approach the markets. I would imagine most of your listeners are investor oriented or swing trading oriented. And while I might be very short-term oriented, primarily in the futures market, S&P futures, 10-year notes, I'm a price level trader. And as I said to you before we came on this afternoon, is that price levels they're agnostic in terms of what type of a trader or investor you are. Markets typically react to certain price levels. So, if you're looking to get long because you think a particular stock is attractive, that level's attractive to you, whether or not you're going to scalp a trade or you're going to put it into your portfolio. So I think what I'm going to talk about today are some key levels which are probably going to provide some direction. Now, granted, the way the volatility has been this year, that direction may be short-lived. It may only be a few days. It could be a few hours. Maybe it'll be a couple of weeks. But I think if investors and traders of any stripe can keep a good handle on certain price levels, they'll get a sense of which way the tape will be moving. And I think that can help them navigate more effectively in these particularly volatile markets.
Yeah, I think it's hugely important, right? You have to have, we talk about this all the time. You have to have a lot of tools in the toolbox. And I think it's especially important right now where narrative has a way of sort of running away with things, and people are kind of thinking about things through either a really political lens or they are getting really married to a narrative. So I think having some of this perspective, at least, as sort of another lens you can look at things through is really, really important. So let's talk a little bit about, and I know you spent a lot of time on the S&P. So we're going to pull that up. If we could do that, and tell me what you're looking at, and tell me also sort of how you approach this, not just the levels you're looking at, but like just from a sort of tactical perspective, how you approach it, especially heading into a huge news event like this.
Yeah, exactly. It says I'm sharing right now. Should I maybe pull out of that?
Yeah, okay, I think we got it.
There we are. Perfect. Well, I think first and foremost, first of all, if you're not a trader, please don't have a seizure by looking at my chart. I know this can be a little overwhelming, but part of your question there was, what levels am I looking at? And most importantly, why is that important? You mentioned that a lot of people come to the market with a narrative. In fact, that's how most of people approach the market. They have a narrative or a bias, and then they're looking to work that bias into the market. And that's fine. But ultimately what drives prices is, where's the big pools of money sloshing back and forth? And as a trader, and even as an investor, I think if you can identify where those pools of money are congregating and likely to react to certain price action, that gives you an edge. So the price levels, or the levels that you see on my chart here, are nothing more than calculations of where lots of volume has taken place over a period of time. So lots of trades at a specific price over a period of time. All that's basically doing is it's giving you a heads up. It's like, hey, a lot of activity took place here. If the market interacts with it, we're likely to either stall, move higher, or maybe just go sideways. But that to me is an edge to some degree. There's no speculation there. It's not an opinion. It's just, this is what the market has done. It's showing us where it's like to hang out previously. So as we all know, this year, we've been extremely volatile, a lot of downside, but if we had more time, or maybe we did this in another session, you would find that most of the inflection points in the crazy market environment we've had this year have all been at price levels which are to some degree knowable in advance, because we all have the ability to look at where prices have been. We all have the ability to look at how much volume was done at that price over what period of time. That's what these levels represent. So what does that mean now? Well, obviously, until we know what the fallout from the tariff announcement will be, it's unclear. But what I do think we have at this point is we have a particular level that we're just butting up against literally today. And that's into this 57.20, 57.40 level. In fact, I'm going to make this chart a little bit longer time frame. I'm going to bring out a 4-hour chart. And you're going to see something just very simple. This has been a level that has been very difficult for us to get back above. We've hit it a couple of times and we've just gone right back down, or we haven't been able to pierce it. And if you go back in time, let's say into early March, this level has been very critical to get through. So from my perspective, it's hard to be, let's say, sustainably bullish, I guess is the best way to describe that, until that market, until prices can get above 57.20, 57.40 and hold it. Anytime, anything prior to that is going to be trading oriented. It's going to be very short term, very choppy. So it's going to require some patience. Will President Trump say some things today that get the market above that? Who knows? But if it does, we know that that at least gives us a fair shake at seeing prices extend to the upside. Now, conversely, and I think everybody can visually see this, 56.20 down to about 5,600. Anything below there, we probably resume some sort of a bearish pattern. Anything in between here, if you're an investor or let's say even a swing trader, probably too choppy, probably too noisy for you. But for a guy like me, I'll get in there and navigate that on a day-to-day basis.
I think that's super helpful. And I think a lot of people are really concerned about the downside right now, because it just seems like there is, the market, by the way, we didn't mention this going on, but this is the S&P, correct? Paul's
That's
asking.
right. S&P futures.
S&P futures, Paul. The market traded a little bit higher today, but it seemed like it was really in a holding pattern, and it feels like there's a lot of concern out there. So I think people are really more worried about the downside right now than they are the upside. When you see a break of that, when you're watching a level, Dave, how do you know whether it's convincing or whether it's just probing or testing? We hear that, right, in articles. What gives you, what makes you say, okay, this is something I really need to pay attention to, not a false signal?
Yeah, well, that's a really great question. Of course, there's never a bulletproof answer, but like anything in life, if you can put a few check marks next to that particular scenario, then at least you can say, you know what, looks like my odds are a little bit better here. And what do I mean by that? For instance, I think what's really important nowadays, and again, it goes back to approaching the market from that pool of money. Where's that pool of money sloshing around? So I look at two additional filters. Price level is the first one. But oftentimes price level is not enough, because like you said, sometimes it could be just a little bit of a head fake and, back down you go, or back up you go if you get short. So what I'm looking for is kind of what I would call a mosaic of a few things coming together. The two primary ones, at least if I'm trading S&Ps, are what's the volatility index doing? VIX. VIX is not, S&Ps are not going to go very far without the VIX doing something at the same time, and they're inversely correlated. So
should we take the S&P down and try to put the VIX up, Dave? Is that something we should be looking at now, or do you want to stay with the S&P right now?
We could just stay with the S&P for now. I think what the most important thing is to know a couple of levels on the VIX that will be catalysts for what the S&Ps could do. So for me, I'm always looking at that confirmation. So let's say I'm looking to get long the S&Ps above that level I told you about at 57.20, 57.40. Since we know that the VIX will be moving lower as the S&Ps move higher because they move in opposite direction, I'm going to want to make sure that the VIX is in a position where it looks as though it's going to sustain that move to the downside. So if that's the case, I'm like, okay, great. VIX is moving lower, S&Ps are moving higher. That's what I want to see. The other thing is that's a bullish play on the S&Ps. How are market internals looking? Are the leaders leading or are the leaders lagging? And the other thing, and this is a little bit harder, but option flows, are we getting a lot of call buying? Are we getting a lot of put buying? Because that in and of itself creates order flow, as kind of a feedback loop. And I don't want to get too in the weeds here because it's a little bit convoluted, but if there's a lot of call buying going on in the market, that ends up forcing the dealers who are selling these call options to traders to buy the underlying to hedge themselves. And then conversely, if there's a lot of put buying on, they have to sell the underlying to hedge themselves. So almost becomes like a self-fulfilling feedback loop. So if you get those other factors coming into play, that increases my conviction on whether the move above 50, and we're above 57.40 right now. We're at 57.50 now.
Okay,
so
that's
news
really
must have just come out on the tariffs.
Yeah, well, I see him speaking right now, and just as framework, I know you're all double dutying, right? We all have 30 screens open right now. So I think that the general consensus going into this was that if it was generally somewhere around 10%, maybe targeted in 10%, it was going to be on the bullish side of just relative to expectations. If it was 20% or 25%, that was going to be a little bit more on the bearish side. So very interesting that you could see the price moving as this is coming out, because he's speaking right now. I am also going to caution for anyone who's trading this, and we'll get back into some levels to watch as Dave was just doing. And it's why it's so important to be looking at this. You also, this is the beginning of what is a long saga with this. So, we've got the announcement now. This is a really quick moving story. So just be careful about trading headlines unless you have the stomach for it and the resources for it. I always feel like we should put that cautionary note out there. But there's going to be a lot of volatility around this. But the headlines are crossing. We'll get the breakdown from Peter when he's able to come back. Trump is speaking right now as we are watching this. But Dave, interesting to see that. And by the way, I feel like let's put that screen up there again, because I feel like that I was like, oh, people are more interested in the downside because there's all that risk. This is why you have to be watching the whole range, right? Because you don't want your narrative to dictate the only spot you're looking at. And I just proved that in real time.
Yeah, I think that's the thing that a lot of people have a hard time with, myself included at times, is that the market doesn't really care about your opinion. And the market only cares about, who's buying at what level and for how much. And if the market's moving higher, and this is oversimplified, but if you do start to frame your trading and investing in this mindset, it will actually make it a bit easier. Is my whole job on a day-to-day basis is trying to get in sync with the market and not get in right as the market decides it wants to change its tune. So that's the key thing. And you try to come at it neutral. Yeah, you might have some ideas. Okay, like I said, okay, above 57.20, 57.40, that should be bullish. Well, that's a reasonable conclusion to draw. But unless the market's moving in that direction, you're just saying, well, the market's clearly not agreeing with that at this point. So until it does, I'm not going to be chasing this move. What you said about chasing headlines here, yeah, I mean, my God, we're moving 10, 15 points at a time here, like in 10, 15 seconds. So this is not for the faint of heart. And there's no, the dust has to settle a little bit, I think, before you can kind of know whether or not this has any legs to it. Interestingly, what I'm seeing off to the side here is that we're sitting on a big support level in 10-year notes, right at a 111.09. And 10-year notes have been quite strong lately, which is, pushing down interest rates. We're at 4.2 on the 10-year. Now, as these S&Ps continue to rally, we're at 57.70 right now almost.
Well, it's interesting because, thank you, Paul. Some folks are adding in the chat saying 25% tariff on all foreign-made autos. So at least in that area, that would have been on the higher, end of the expectation. So it's interesting that the market's moving so much on this. I don't know if I can put the screen back up, Dave. If you can, your chart, feel free to, if you want to, while you're talking about this. But what, again, like, I think that when things are moving, how do you, and I'm going to come back to this because I think it's a really important point. How do you deal with a really volatile market and keeping track of the levels? Like, when do you decide that the range has shifted? We were just talking about it's like sort of taking out some of your upside targets. How do
Yep.
you decide to sort of shift that up, or whether you still need to operate in that range you initially laid out? Is it time? Are you looking at 200-day moving averages? How are you deciding what are the levels that are key?
Okay, well, this is actually, the perfect time to kind of walk through this. I mean, if we were in normal market hours, I mean, technically, yes, the futures are still open. They're open for another 40 minutes or so, and then they'll close for an hour. So I'm not going to be doing anything in here. But if let's say this move was happening midday, we break above that level, I'm going to want to see, and I'm not chasing. I'm not one of those guys that just blindly buys a breakout. But if we come back and retest that, or at least pull back, and maybe we don't retest 5740, but we stall above it and just kind of mark some time, that might be just enough for me to get in. Now, the one thing I would say, which is the precursor to the first part of your comment and question, was the volatility. I'm definitely trading smaller lot sizes in these markets because we're just getting, really, really big moves. I'm not going to be trading my normal lot size for a fairly neutral market. I mean, we just went from 57.70 all the way back to 57.45. I mean, 30 S&P points, that's a lot. That's $1,500 per contract in like 2 minutes. So that's not the type of market you want to be trading your normal lot sizes. You want to be trading fractional lot sizes, but that's a side note. But we are getting like pullback into that level that we broke out above, 57.40. We're at 57.48 right now, give or take. If we start to hold that level and start to move back up, that seems like a reasonable area to go long. Again, if we were under normal daytime conditions, VIX is moving lower, market internals look pretty strong. That's a trade that makes sense to me. So that's how I would normally play it. Let the level break, see if the market wants to hold it, and then try to hitch your wagon on some sort of a pullback. I know that sounds overly simplistic, but there's no magic bullet where you're going to know exactly what price to get in at. Sometimes that happens, but more times than not, it's a question of getting in sync with what the market's doing and believing that by breaking above or below a level, you've now entered a period where you're going to get prices to expand, or to trend, get into a more of a trend-like manner.
Yeah. So we had a question before, and again, just as an update, Trump is still speaking. Hopefully Peter will come back to us when we get headlines out, but nothing happens quickly in Washington. Well, until it does, I suppose. But we had a question about internals from J&J, and he was asking, do you have an opinion on the internals of the market? You mentioned that as well before as a sort of secondary thing that you look at for confirmation. What does that mean for people who may not be looking at that, and why is it important? And I guess, do you have an opinion on that?
Well, I think market internals are helpful, and there's a number of ways you can look at them. But, again, it's just internals, up volume, down volume, percentage of stocks above, let's say, a 50-day moving average. Those type, how many issues are up on the day in the S&P 500 relative to the number of issues that are down, or you could do the same thing in the NASDAQ. It's taking the temperature of what the market's doing. So you could easily on any given day have the NASDAQ or the S&P 500 up quite a bit, but under the hood, so to speak, a lot of the stocks are lagging. That can happen. That doesn't mean you can't be a buyer of the S&Ps or NASDAQ futures, but I look at that and I'm like, not the ideal setup. The underlying stocks are kind of lagging. And that leads me to believe that, at any given time, the futures could maybe catch up with that, or maybe the stocks end up catching up and the market goes higher. Again, you're just trying to line up probabilities. So I think market internals are a good thing. And what I like about them is they're black and white. You don't look at them and go, geez, what's it trying to tell me here? No, it's pretty clear. Up volume is more than down volume, i.e. that's fairly bullish.
Yeah. Okay. We're gonna let's get Peter back in for a second.
Sure.
And then we're gonna get some thoughts for him. Hey, Peter.
Hey, Maggie, how are you?
Great. So thanks. I know, listen, it's crazy, and I know you've probably got clients ringing your phone off. So let's just get a couple of thoughts from you. I don't know how much you were able to get from that, but it looks like I'm seeing headlines that baseline tariff 10%. That seemed like on the best case scenario of a already uncertain negative situation. Did you hear anything that you can react to?
Well, coming into the day, it was going to be either one lane or the other, or both. One being, are we just going to focus on the reciprocal issue and we'll raise tariffs to the same level that other countries have on us for the same product? And then the other side was, are we just going to throw on blanket tariffs? I think either way, going into today, we were all hoping that this would be it. This is the tariff news. We can digest it and then we can move on. But it doesn't seem like that is the case, because the focus today is just a 10% blanket tariff. But the implications were, well, maybe that can be negotiated away. And rather than focusing on individual products, which I think would be a logistical nightmare anyway, that doesn't seem to be the case. So this seems to be more just a blanket one. Now, whether they take it off, if some country lowers theirs, I don't know. I think the confusion continues. And it's basically a 10% tax increase on imported goods, which total about $3 trillion. So it's about $300 billion a year. And we'll see whether they try to apply that to extending the expiring tax cuts in terms of the reconciliation bill. But these are tariffs that U.S. importers will pay, and then we'll see to what extent they can sort of recapture it from a foreign exchange move, or the exporter will eat some of it, or they try to raise prices to the rest of us.
Yeah, I mean, this is one of the big questions, right? It's in theory, and I think the administration's saying it's going to raise some $6 trillion over the course of it. In theory, this is
now it'll be $3 trillion.
Right, 3, and in theory, this is something that foreign businesses will pay, non-U.S. businesses, I should say. But we don't really know if that's the case. Like, right?
No. U.S. importers pay the tax.
So that U.S. companies
of what they can recapture through either a move in the currency, or the exporter to us discounts their products, or me as a business pass it on to my consumer.
And this is where I think the risk is.
U.S. companies pay this tariff that they give to the Customs Bureau or administration, and then they go from there.
Yeah, and I think that's where a lot of the confusion and the economic risk is. Can you talk a little bit about the uncertainty? Because it seems like even more than the tariff themselves, and I know, again, you're always listening to the conference calls, you're digging in. And by the way, Peter said, I think it was back in November, December, that you were worried that the market was overly complacent about the issue of tariffs. Maybe it was October when we talked. I mean, it was really early on that you sort of really nailed that this was an issue that people were not really looking at through the lens of risk, that we certainly have seen what that's done to the market. Is it the tariff itself, or is it actually the uncertainty around them? What kind of impact is that having on businesses? What are you hearing from executives?
Well, it's a combination. I mean, if this is it, and then businesses can try to adjust and manage whatever tariff. Unfortunately, it doesn't seem like this is it, and this tariff rate can change depending on what country, what product you're managing in. Not all the details are coming out. It's still in a speech, so we'll have to see if it's 10%. That's it. But this is now a global sort of trade tariff battle, because before it was, okay, I'm going to go after Canada and Mexico. I'll tariff China. I'll threaten anybody who buys Venezuelan oil. Now this is just a blanket tariff. So this is a revenue raising event. Is this going to be enough to reshore production back to the U.S.? Probably not. We have experience of that in 2018, and I'm not sure how many more steel plants we got from that. So yes, on one hand you have some certainty, but not all. But on the other hand, now you got to deal with the pain of managing this.
I think that there is a widespread worry that this is going to cause an economic shock that's going to force the U.S. into recession. Is that a reasonable concern? Is that a risk? Is that a realistic risk that people should be scenario planning for?
Well, we'll have to see what the reciprocal tariffs are, because the rest of the world's not just going to sit there and do nothing. Hopefully, if they lower some of their tariffs, we can lower that 10% on them. That's the ideal situation, but we'll have to see. I'm not sure if tariffs in and of itself will, because we're talking about $3 trillion worth of goods, talking $300 billion tax of a $30 trillion economy. But the issue is it's happening with other potential things that could cause a recession. Government spending has been a major lift to GDP growth. Well, if we're now going to, through DOGE and other budget initiatives, if we start to slow the pace of government spending, well, that's a good thing, big picture, long term, but that in the short term could result in an economic hit. If the stock market continues to trade pretty choppy here or takes another leg down, that in itself will raise recession risks, because upper income spending has been a key lift to GDP growth. And all eyes are also on AI capital spending and whether the pace at which we've seen can be sustained, because capital spending ex AI has been flatlining. So the risks are definitely rising for all these factors, not just tariffs.
Yeah. I think that is something we're all trying to grapple with. Peter, I'm going to cut you loose and let you go, because I know that you need to listen to the rest of us. We so appreciate you rocking and rolling with us here as this is going on. President Trump is still on screen, so you can get Peter's full breakdown of this in his work. You can find him on Substack. We have the links, and of course at Bleakley. Peter, thank you so much. We appreciate it. I just want to go back to Dave. Dave, I want to get some final thoughts from you.
Well, I'm glad it is. I mean, it's. You probably aren't watching charts. We've completely melted down while Peter was talking. I had nothing to do with Peter, of course, but
yeah, this is this is a taste of what's going to happen here. So put the chart up again.
Context in it.
Yeah, put the chart up again, if you will.
Yeah, I mean it's nutty. I could tell you while I was sitting here. I'll put the chart up. I mean, wow, I mean, it's really quite crazy. And let me bring the chart up, and it'll speak volumes.
And again, just as a reminder, this is after it looked like it was melting up at the beginning of this. And again, Trump is still speaking. So like whatever we're saying now, if you're listening to us live, you're seeing it happen. But if you're listening after the fact.
So here we go. I told you guys about the magical 5640 level. And I'm sorry, 5740. And you can see it maybe pretty clearly. We went way above it, almost up to 5780. And now look at us. We're 180, almost 200 points lower.
So is this, in terms of the sort of volatility you're used to seeing, quantify that move for me.
This is pretty crazy. I mean, we've had some volatility, no doubt, but this is exceptional volatility. This is one of those things where you catch lightning in a bottle, or you're picking an arrow out of your back right now. Now, what I would note here is this is obviously a significant deterioration. We failed at all the resistance levels that I thought would, or that I suggested would say, be a bullish environment. Not so much. But what did happen right when this took place, I told you 10-year notes were holding 111.08. They're now at 111, almost 112. So they've rallied half a point, which is a big move in 10-year notes in that short of a time frame. So we're getting a complete opposite. We're getting a very risk-off environment here. 10-year notes are rallying. And conversely enough, or oddly enough, we're right back to another very, very key level in the S&Ps. And I know it's kind of weird that I'm saying 5,600, because you could say, well, geez, Dave, anybody can pick 5,600. It just happens to be coincidence, but a ton of volume has traded at that level over the last couple of months. And that sticks out as a very key level. And we've bounced off it thus far. We've gone from 56, now we're at 56.35. So we're back into that nasty trading range. So for investors and swing traders, there's no visibility now. We were clear for a while. Things were looking good. Now we're right back in the muck. So
yeah, and I think that this is the challenge when you're in a headline-driven market, because as I'm looking at them cross, even though we were just talking to Peter about 10% blanket across the board, now we have headlines: 34% tariffs on China, 20 on EU, 24 on Japan. I think I saw a 4 number for Vietnam. And remember, some of this is algorithmic, right? So there are
Oh, yeah.
computers seeing the headlines, and just if they were set for 20% bearish, I mean, it's going to take, days. There we could be seeing days of volatility as we try to sort of work through this. And then let's see if there's individual negotiations. I mean, this is some of the uncertainty that's been roiling everyone and executives and people running companies very hard to make future plans when we're in this kind of thing. Paul in the chat just said, run for cover, which is probably how a lot of people feel. So Dave, as we go into tomorrow, I just want to ask you two things. First of all, we also saw sort of Bitcoin moving briefly earlier. Now it may be on down as it's risk off. When you see like the S&P moving and then you see things like Bitcoin moving, do you watch that? Is that just a risk asset move across the board? Does that give you any confirming signals? Is that on your radar at all?
It's on the periphery, and I think the correlation of Bitcoin up, S&Ps and NASDAQ up, that correlation's broken down a little bit, but not much. But I wouldn't, for me personally, and I'm not speaking from any hard evidence. I don't put a lot of weight into it, but there may very well be some relationships there that I'm just maybe blissfully unaware of. I think the best way to leave, our conversation today and leave some levels for your viewers is really quite simple. We've got 5,600 to 5,620. That's going to keep the bears at bay, meaning we stay above that. 5720 to 5740 is going to keep the bulls at bay until we get back above that. Anything in between is going to be very choppy. And it's not that absolute. You don't simply go, you're not a full-on bear below 5620, and you're not a full-on bull above 5740, but they're good landmarks. I think the big level to look at really is actually in the VIX, in the volatility index, because that's going to be where big money expresses an opinion on forward-looking volatility. So I would leave one level in mind for everybody to watch, and that's 22 even on the VIX index. If we hold above that 22 level, that would be a very bearish sign, not very bearish, but an immediately bearish sign for the S&Ps. Because remember, as the VIX moves higher, S&Ps move lower and vice versa. Now, if we stay below 22, which is where we closed the New York session, that would be bullish. But that VIX is going to adjust tomorrow morning if the S&Ps stay weak. That VIX will probably open up above 22 if the overnight futures market stays weak. So tomorrow, 22 is the really, really big level in the S&Ps, in the VIX that people want to pay attention to. And if we stay above that, we're probably going to go up towards 2351. And if we get above that, it's not going to be looking good for stocks.
All right. We will consider ourselves warned. Dave, it was wonderful to catch up with you. I think so important on a day where the narrative is running riot with us here after hours, to have some really good sort of technical framework and levels to help ground us as we try to navigate this volatility. So really appreciate you. At the last minute, as you know, I rang him up and asked him if he'd jump on to sort of help us. So I really appreciate it, Dave.
Oh, not a problem. That's what us short-term traders do. We react to things.
Exactly. And we appreciate it. Again, you can find Aspen Trading link for more on Dave's work in the description. Thanks, everybody. Listen, it's going to be a couple of crazy days. Good luck. Take care out there.